As a business owner, reducing your yearly tax liability should be one of your top priorities. There are many ways to do this, but they can vary based on what kind of organizational structure you've decided to build your business as. Hi, this is Michael with J. Heath & Company CPAs, and in this video we will be going over the S Corporation tax election, which has various costs and benefits compared to LLCs, partnerships, and C corporations. While there are some drawbacks, the S corporation structure is built in a way that usually produces the most tax savings compared to the rest. Let's start with the basics. An S corporation, or S Corp, is a pass-through entity. This means that it allows taxable income, credits, deductions, and losses to pass directly to its shareholders. They then report this information on their personal tax returns and are assessed the tax at their individual rates. An immediate benefit of this is that it avoids the double taxation of corporate income that occurs in other business structures. To qualify for S Corp status, your business must meet the following criteria. It must be a domestic entity. There must be no more than 100 shareholders, and they may only be individuals, certain trusts, or estates. This means no partnerships and no C corporations can own shares. There must be only one class of stock, and you can't be operating an ineligible business such as an insurance company, domestic international sales corporation, or certain financial institutions. Different legal entities come with different operating requirements, but in general the S Corp structure does share some aspects with other tax elections. For example, S Corps provide its shareholders with limited liability towards the debts of the business. Assets and liabilities are owned by the corporation itself, so shareholders are rarely held responsible for issues related to them. Just keep business and personal separate, and you'll have a lot less to worry about. You can also face similar formalities such as filing responsibilities and corporate obligations, adopting bylaws, issuing stock, holding shareholder meetings, and filing annual reports to name a few. These are required for most entities that operate above a sole proprietorship, and we here at J. Heath & Company will gladly help you set everything up when you're ready to expand your business. Now, let's start off with the administrative costs of operating an S corporation. When operating as an S Corp, you'll face more scrutiny from the IRS regarding how you pay your employees and shareholders. Instead of solely issuing profits to your shareholders through corporate distributions, you'll need to administer W-2 payroll, and each shareholder will need to pay payroll taxes, such as FICA and unemployment taxes. Naturally, the business will also need to start paying payroll taxes as well. These payroll taxes will be paid each quarter, as well as annual taxes at the end of each year. The wages they earn will then be taxed under each shareholder's individual tax rate. After payroll is paid, other corporate distributions are allowed to be given to shareholders. Some structures allow you to distribute these profits and losses however you please, but S Corps must distribute based solely on the percentage of shares each owner has control of. Creating an S Corp can also cost time and additional fees such as potential annual report fees and franchise taxes. On the upside, those fees are usually deductible as a necessary business expense, so paying them may reduce your yearly tax liability. Finally, depending on how you want your business to expand, an S Corp does face limits on its ability to grow due to the limit on the number of allowable shareholders, as well as the kinds of shareholders allowed. Thankfully, the benefits of operating an S corporation usually outweigh the costs. For example, we've already talked about how the S Corp election allows you to bypass the double taxation other corporations deal with. But by classifying the money they earn from the business as payroll, shareholders can also avoid paying any additional self-employment tax. Plus, the money paid to employees as salary, and the money paid by the business for yearly payroll taxes, are counted as necessary expenses and are therefore deductible. So, while you will be making more payments throughout the year, the total amount paid generally decreases when operating as an S Corp. Beyond standard payroll, S Corp shareholders can also receive corporate dividends that can remain completely tax-free. If the dividends received don't exceed the shareholder's stock basis, the entire amount remains untaxed. And even if the dividends exceed the stock basis, the excess amount is taxed at a lower rate because it's treated as a capital gain. Lastly, eligible S Corp shareholders are allowed to take an additional deduction of up to 20% of what's considered net qualified business income. Remember, your potential S corporation exists at the discretion of the IRS. Establishing your business as an S Corp requires the filing of Form 2553, and if the IRS finds you in non-compliance, they have the power to remove your S election. If interested in setting up your business as an S Corp, or if you have any other questions about the tax election, please reach out to our office and we will be happy to help.